Most people don't lose money in trading because they choose the wrong stock, the wrong crypto, or the wrong forex pair. They lose money because they don't know how to manage risk. You can be right about the market direction and still blow your entire account if your risk management is bad. This is the hidden truth about trading that almost no beginner understands. Everyone focuses on strategies, indicators, and signals, but professional traders focus on only one thing first: how much they can afford to lose on a single trade. Risk management is not just a rule, it is the foundation of survival in trading. Without it, trading is not a business, it is gambling. Risk management in trading simply means controlling how much money you risk on each trade, so that one bad decision cannot destroy your account. The goal is not to avoid losses, because losses are a normal part of trading. The real goal is to make sure that losses stay small and wins become bigger over time. A professional trader thinks in probabilities, not in emotions. They know that even the best strategy in the world will still have losing trades. That is why they design their system in a way where even if they lose multiple trades in a row, their account is still safe and they're still in the game. The biggest mistake beginners make is risking too much on one trade. They go all in, they use high leverage, or they risk 20%, 30%, even 50% of their account on a single position. This is financial suicide. When you risk big, you don't just lose money, you lose confidence, discipline, and mental control. One big loss creates fear, then fear creates revenge trading, and revenge trading creates even bigger losses. This emotional cycle is what destroys most trading accounts, not the market itself. Professional traders follow a simple rule: never risk more than a small percentage of your total capital on one trade. For most traders, this number is between 1% to 2%. That means if you have a $1,000 account, you should not lose more than $10 to $20 on a single trade. This sounds boring and slow, but this is exactly why professionals survive for years while beginners quit in months. Small risk keeps your emotions stable, your mind clear, and your decision-making logical. Another core concept of risk management is position sizing. Position sizing means how big your trade should be based on your stop loss and your account size. You don't choose position size based on how confident you feel. You choose it based on math. If your stop loss is far, your position size must be small. If your stop loss is tight, your position size can be bigger. This way, no matter what the market does, your maximum loss always stays within your planned risk. This is how traders control chaos in an unpredictable market. Stop loss is one of the most important tools in risk management. A stop loss is a predefined point where you accept that your trade idea is wrong and you exit with a small loss. Many beginners hate stop losses because they don't like being wrong. They move their stop loss, remove it, or ignore it, hoping the market will come back. This is pure emotion, not logic. The market does not care about your hope. A stop loss is not your enemy, it is your insurance policy. It protects your capital, so you can trade tomorrow, next week, and next year. Good risk management also means understanding risk to reward ratio. This is the relationship between how much you risk and how much you expect to make. For example, if you risk $10 to make $30, your risk to reward ratio is 1 to 3. This means even if you lose more trades than you win, you can still be profitable. Many professional traders only take trades where the potential reward is at least 2 or 3 times bigger than the risk. This creates a mathematical edge over time, even with a low win rate. At the end of the day, risk management is not about making money fast, it is about not losing money fast. Anyone can get lucky and make profits for a few days or weeks, but only traders with strong risk management can stay consistent for years. The market is a marathon, not a sprint. If you want to survive and grow in trading, you must accept one simple truth: protecting your capital is more important than making profits, because if your capital is gone, your trading journey is over. Another critical part of risk management is understanding that not every day is a trading day. Many traders feel pressure to trade every single day because they think more trades mean more money. In reality, more trades often mean more mistakes. Professional traders are very selective. They wait for high-quality setups that match their strategy and their rules. If the market is unclear, too volatile, or not offering good opportunities, they simply stay out. Sitting in cash is also a position. Not trading is sometimes the best risk management decision you can make. One of the most ignored aspects of risk management is emotional control. Your emotions are actually one of the biggest risks in trading. Fear, greed, impatience, and overconfidence can destroy even the best strategy. After a big win, traders often feel invincible and start increasing their risk. After a big loss, they feel desperate and try to recover quickly. Both situations lead to poor decisions. This is why professional professionals follow strict rules and treat trading like a business, not like a casino. They do not change their risk based on mood, news, or hype. Diversification is another powerful risk management technique. This means not putting all your money into one asset, one market, or one strategy. If all your capital is in a single stock or a single crypto coin, one bad event can wipe you out. But if your capital is spread across different trades, different assets, or even different markets like stocks, forex, and commodities, your overall risk becomes much lower. Diversification does not eliminate risk, but it reduces the impact of a single failure. Leverage is a double-edged sword and one of the most dangerous tools in trading. Leverage allows you to control a large position with a small amount of money. While this can increase profits, it can also multiply losses at the same speed. Many beginners use high leverage because they want fast results. They see small price movements and think it's easy money. What they don't realize is that high leverage leaves no room for mistakes. Even a small move against you can liquidate your entire account. Smart traders use low leverage or avoid it completely until they are highly experienced. Another important rule of risk management is having a maximum daily or weekly loss limit. This means deciding in advance how much you are allowed to lose in a day or week before you stop trading. For example, if you decide your daily loss limit is 3%, once you hit that limit, you close your platform and walk away. This rule protects you from emotional spirals and revenge trading. It forces you to respect your capital and prevents one bad day from turning into a disaster. Risk management also includes keeping a trading journal. A trading journal is where you record every trade, entry, exit, stop loss, position size, reason for the trade, and how you felt emotionally. Over time, this data becomes extremely valuable. You start to see patterns in your behavior, your mistakes, and your strengths. The best traders in the world are obsessed with reviewing their performance. Finally, true risk management is about mindset. You must accept that losses are part of the game. There is no strategy with 100% accuracy. Even legendary traders lose trades regularly. What makes them successful is not that they avoid losses, but that they control them. They think long-term, not trade by trade. They focus on consistency, discipline, and process, not on quick money. In the end, the traders who survive are not the smartest, not the fastest, and not the most aggressive. They are the ones who respect risk the most. They understand that their number one job is not to make money, but to protect their capital. Because in trading, capital is your weapon, and risk management is your shield. Without a shield, you will not last long in the market.
Another advanced layer of risk management is understanding market conditions and adjusting your risk accordingly. The market does not behave the same every day. Sometimes it is trending, sometimes it is ranging, sometimes it is extremely volatile, and sometimes it is completely slow. A smart trader never uses the same risk in all conditions. When the market is unstable or full of fake breakouts, reducing your risk is a sign of intelligence, not fear. Increasing risk only makes sense when your strategy is performing well and the market environment supports it. Correlation is another hidden risk that most traders ignore. Correlation means how different assets move in relation to each other. For example, many stocks move together, many crypto coins move together, and some forex pairs are strongly connected. If you take multiple trades that are highly correlated, you might think you are diversified, but in reality, you are taking the same trade multiple times. If the market moves against you, all positions can lose at the same time. This creates a much bigger loss than expected. Real risk management means understanding correlations and avoiding overexposure to the same idea. Overtrading is one of the silent account killers. Overtrading means taking too many trades without real reasons, usually out of boredom, impatience, or addiction. The more you trade, the more transaction costs you pay, the more emotional you become, and the higher the chance of mistakes. Professional traders do not measure success by how many trades they take, but by how many good trades they avoid. They wait for clear setups and ignore everything else. This discipline is a major part of long-term risk control. Another powerful concept is expectancy. Expectancy is the average amount you expect to make or lose per trade over a large number of trades. It is calculated using your win rate and your risk-to-reward ratio. Even with a low win rate, like 40%, you can still be profitable if your average win is much bigger than your average loss. Risk management is what makes positive expectancy possible. Without proper risk and reward planning, even a high win rate strategy can lose money. Capital allocation is also part of professional risk management. This means deciding how much of your total wealth should even be in trading. Smart people people never put all their savings into one trading account. They keep emergency funds, long-term investments, and only allocate a portion of their money to active trading. This protects their life from market risk. When trading becomes your only source of money, emotional pressure increases and decision quality decreases. Financial stability outside trading creates mental stability inside trading. One of the most important psychological rules is to never try to get rich from one trade. This mindset is extremely dangerous. The moment you start thinking that one trade will change your life, you automatically increase risk and ignore rules. This turns trading into a lottery. Professionals think in series of trades, not in single outcomes. They know that real success comes from hundreds and thousands of small, disciplined decisions, not from one lucky shot. Risk management also means knowing when to stop. If you are tired, stressed, angry, or distracted, you should not trade. Your mental state directly affects your performance. Trading while emotional is like driving while drunk. Even a good strategy cannot save you. Many traders lose money not because of the market, but because they trade at the wrong time in the wrong state of mind. In reality, risk management is what separates amateurs from professionals. Amateurs focus on how much they can make. Professionals focus on how much they can lose. Amateurs chase profits. Professionals protect capital. This shift in thinking changes everything. Once you truly understand that your main job is survival, your trading becomes calmer, more consistent, and more powerful. At the highest level, trading is not about predicting the market. It is about managing uncertainty. You cannot control the market. You cannot control news, and you cannot control outcomes. The only thing you can control is your risk, and the trader who controls risk controls their future in the market. Another important dimension of risk management is understanding drawdowns and how to survive them. A drawdown is the decline in your account from its peak to its lowest point after a series of losses. Every trader, no matter how skilled, will face drawdowns. The difference between successful and failed traders is not who avoids drawdowns, but who knows how to manage them. When your account is in drawdown, your first responsibility is not to recover losses quickly, but to slow down, reduce risk, and protect what is left. Most traders do the opposite. They increase position size to recover faster, which only deepens the damage. Professional traders accept drawdowns as part of the business. They reduce their risk during losing streaks and increase it slowly only after consistency returns. Another key concept is compounding and how risk affects growth over time. Compounding means reinvesting profits so your account grows exponentially, but compounding only works if your risk is controlled. If you lose 50% of your account, you need 100% return just to get back to break even. If you lose 80%, you need 400%. This shows how destructive big losses are. Risk management protects you from deep drawdowns so that compounding can actually work in your favor. Slippage and spread are also hidden risks that many traders ignore. Slippage means getting a worse price than expected during entry or exit, especially in fast markets. Spread is the difference between buy and sell price. These costs may seem small, but over hundreds of trades they become significant. Good risk management means choosing liquid markets, avoiding low-quality brokers, and not trading during extreme news events where slippage can be huge. News and events are another major source of risk. Economic data releases, interest rate decisions, earnings reports, and geopolitical news can cause sudden and violent price movements. Even with a stop loss, the market can gap and skip your level, causing bigger losses than planned. Many professional traders avoid trading during major news or close their positions before important events. This is not fear, it is awareness of uncontrollable risk. System risk is also part of risk management. This includes technical problems like internet failure, platform crashes, broker issues, or even power cuts. These things can happen anytime, especially in online trading. Smart traders always prepare for worst-case scenarios. They use reliable brokers, backup internet connections, and never leave huge positions open without protection. They understand that risk is not only in the chart, but also in the system they use to trade. Another advanced rule is scaling in and scaling out. Scaling in means entering a position in parts instead of all at once. Scaling out means taking profits in parts instead of closing the entire trade at one level. This technique reduces emotional pressure and smooths performance. It also reduces the risk of bad timing. Instead of trying to catch the perfect entry or exit, traders manage risk by spreading decisions over multiple
multiple steps. Risk management also means respecting your strategy's limits. Every strategy has a context where it works best. Some strategies work in trends, some in ranges, some in high volatility, some in low volatility. Using the same strategy in the wrong environment is a form of risk. Professionals know when their strategy is out of sync with the market, and they either adapt or step aside. In the end, real risk management is not a single rule. It's a complete lifestyle of thinking. It affects how you trade, when you trade, how much you trade, and even why you trade. It teaches patience, discipline, humility, and self-control. Without these qualities, no amount of knowledge or indicators can save you. Trading rewards those who respect uncertainty and punishes those who try to dominate it. The market is always bigger than you, stronger than you, and smarter than you. The only way to survive in such an environment is to manage risk with seriousness and consistency, because in trading, you don't need to be perfect. You just need to stay alive long enough for your edge to work.
Finally, let's talk about building a complete risk management mindset, which is the difference between amateurs and true professionals. Risk management is not just about numbers or rules. It is about behavior, discipline, and consistency. Every decision you make in trading should pass one question: am I protecting my capital? If the answer is no, the trade is not worth taking, no matter how tempting it looks. Professional traders live and breathe this mindset. It becomes automatic, not optional. It is the invisible shield that allows them to survive even the harshest market conditions. One advanced technique used by top traders is scenario planning. This means thinking about all possible outcomes of a trade before entering. What if the market moves against me? What if there's a gap? What if news hits? By planning for multiple scenarios, traders know exactly how much they are willing to lose, how they will react, and when they will exit. This level of preparation reduces panic, improves decision-making, and limits emotional mistakes. Trading without scenario planning is like walking blindfolded in a storm. You might survive, but it is pure luck. Psychological resilience is another key pillar. No matter how perfect your risk management rules are, you will face losing streaks, drawdowns, and unexpected events. The market will test your patience, your discipline, and your ego. A trader without mental resilience will abandon rules, increase risk, and spiral into bigger losses. True risk management is as much about training the mind as it is about managing money. Meditation, journaling, routine review of trades, and disciplined habits are part of this mental preparation. Continuous improvement is the final piece of the puzzle. Risk management is not static. Markets evolve, volatility changes, and strategies that once worked may stop performing. Professional traders constantly analyze performance, review losses, refine rules, and adapt their risk parameters. They are humble enough to admit mistakes, disciplined enough to change, and patient enough to wait for consistent results. This ongoing process ensures that risk management evolves alongside the trader and the market, keeping the edge alive over time. In conclusion, risk management is the backbone of successful trading. It protects your capital, controls emotions, preserves discipline, and allows compounding to work in your favor. The rules are simple. Never risk too much, use stop losses, respect risk to reward ratios, avoid overtrading, diversify positions, and plan for the worst case scenario. But the true power lies in mindset, the ability to prioritize survival over immediate profits, patience over impulsiveness, and consistency over luck. Remember, the market will always be unpredictable. You cannot control it, but you can control how much it affects your life and your account. Master risk management first, and profits will naturally follow. Without it, even the best strategy, the sharpest indicator, or the luckiest streak will not save you. Risk management is not an option. It is the lifeline that keeps you in the game, day after day, year after year. This is the core of professional trading. Survive first, profit second. Protect your capital, respect uncertainty, and the market will reward you, not immediately, but consistently over time. That is how traders become successful, not by chasing every opportunity, but by controlling the risk in every decision they make.